Hey, welcome back. It's been a wild earnings season. Two of the companies that I own and have recently bought, Toast and Amazon, have recently reported earnings results. Another major earnings report came from Meta, which is a stock that I don't currently own, but obviously I keep an eye on it. Now, it's interesting to me as I see the reaction to Toast's earnings report as falling somewhat in between the reactions of Amazon and Meta's reports, but there is a common theme that permeated all three. All three of these companies are, to some extent, sacrificing immediate profitability and or free cash flow generation for future growth. And yet the market's initial reactions to the three reports were very different. It seems to me that the market's reactions were based on a few primary factors. Number one was how much did people trust the capital allocation of each business, at least after the initial reports. Number two was how much had the stock already run up before the earnings report, and how much was already priced into the stock leading up to it. And number three was how much different was the report from the market's expectations, and how much uncertainty did the report itself actually create. In the case of Amazon, the stock had sold off in the past when they reported and said capital expenditures would be high. So I think going into the report, the market already expected that. After prior earnings reports, management made it a point to articulate that they felt they had the demand to justify spending as much as they were on capital expenditures. And then during this report, they seemed to do a better job of reassuring the market that they wouldn't spend the money if it wasn't going to help generate a high return on the investment. As a result, the stock soared. In the case of Meta, the market did not seem to trust Mark Zuckerberg's capital allocation as much, at least initially. I think there are still memories of the stock's 2022 sell off after the market questioned investments in reality labs and the metaverse. I also don't think the market quite understands how much Meta's AI model development will benefit the company yet. And the fact that there seems to also be some real questions about how they'll use all of the compute that they're buying. The message is kind of a short list of we'll try to monetize it in a way that augments our other products, but if we can't, we'll sell our extra compute. And that only works if there's another buyer who's willing to pay enough to justify the initial investment. You couple that with lawsuits and the fact that people are referencing Meta's products in ways that compare them to cigarettes, and you can understand why the stock sold off. All in all, whether the market rewards a company's stock or punishes it for its capital allocation is ultimately going to come down to how much it trusts the plan that's being presented. In Amazon's case, the market trusted the plan. In Meta's case, initially, it did not. Now, in Toast's case, it seems it didn't initially either, as is evidenced by the price action for the stock after hours. But the stock then gapped up and was green the following day, so I guess the market changed its mind. I made the case in my last video about stocks I bought and sold in June and July that I think Toast could become like the iPhone of restaurants, and I still believe that to be the case. The earnings call actually did nothing but add to my confidence when I listened to what management had to say, and the CEO is one of the co-founders, so that doesn't hurt either. Like Amazon and Meta, Toast is investing in its business. Toast has a clean balance sheet with a market cap greater than its enterprise value and is investing in ways that balance growth and profitability. On the earnings call, management made the case that their capital allocation will be disciplined. So we'll take a look at the earnings report. But before we do, I just want to give a quick overview of Toast's business. Toast offers point of sale, business management, and payment processing solutions that are geared toward restaurants, but are also marketed toward retail establishments. The restaurant niche is part of what sets them apart from competitors like Square and Clover. They offer countertop terminals, handheld devices that your restaurant servers can carry around with them, and kitchen display systems. They also offer a host, pun intended, of software and digital solutions like inventory management. They also offer solutions for things like marketing, promotional, and SMS communications with customers, website and phone app creation, integration with Uber Eats, DoorDash, and Grubhub, advertising solutions, loyalty program solutions, gift card solutions, payroll solutions, basically everything you might need as a restaurant or retail establishment to try to maximize your business. On top of that, they offer ways to try to leverage all of your data and improve and grow your business. And that includes their Toast IQ Grow product, which they say includes a powerful AI marketing agent, dedicated human support, and our core growth tools all in one package, driving revenue from every angle. So essentially, Toast offers integrated solutions that can drive an entire business. Once a business is using Toast, it becomes incredibly sticky because if you're operating your business every day and Toast is your solution to so much of the regular operations, you're not likely to want to change from that and disrupt your operations for a platform transition. Furthermore, aside from selling these solutions, Toast also makes money from processing payments. So essentially, there are three primary ways that Toast generates revenue. One is from selling subscriptions to their digital products. You can basically see this on the income statement as subscription services. And if you look at the cost of revenue section, you can see I added that the gross margin for this segment was almost 78% in the most recent quarter. The second way they generate revenue is from what the income statement lists as financial technology solutions, which is the payment processing and related solutions part of the business. You can see the gross margin there is not nearly as high as it is for subscription services. Finally, the last business segment is hardware and professional services. Toast has historically been willing to sell its hardware and related services at a gross loss in order to get businesses onto the platform with the idea that they will then benefit from processing transactions and selling subscriptions. So let's take a look at the earnings release from their last report, and then I'll give you a 5-year valuation model for the stock. I've marked this up with some notes, so as we go through, I'll explain some of what I have noted. You can see in the top box here, they added approximately 9,500 net new locations in the second quarter. Annualized recurring run rate grew 25% to $2.4 billion as of June 30th, 2026. Net income was $154 million and adjusted EBITDA was $221 million in the second quarter. And they repurchased 19 million shares for $486 million year to date through June 30th, 2026. This tells me that, like I thought Toast stock was a good deal when I bought it, management might have been thinking that as well. And I noted here that this is solid growth and they are growing while returning capital to their shareholders. Here I highlighted a few things because their recurring gross profit streams grew 28%. Recurring means that it's continuing to happen, right? This is a positive sign for the business. GAAP operating income margins expanded, which when you're seeing margin expansion, that's also a very good thing for the business. And then Toast IQ Grow, they said, was the fastest growing new offering they have ever launched. So if you remember when I talked about what Toast IQ Grow was when I went over the business, they're saying that that part of the business is really growing, which is good because that's going to go with the subscriptions revenue, which is high margin. For some of these metrics in this next part of the earnings release, I went back and looked at quarter two 2025, and I just put some notes in here that a lot of these had good growth, but there were some slowdowns in some of the growth rates. That's not that abnormal as a business grows for it to become more difficult to maintain the same growth rates. So, not necessarily something that you need to be alarmed about necessarily, but something that I did note. Net cash provided by operating activities was $144 million, and free cash flow was $130 million in quarter two 2026. And so this was lower than quarter two 2025. This came up, and I actually think this is where the earnings call might have helped the stock after the earnings report. So this is a quote from Elena Gomez, who is the CFO. She's the CFO of Toast. And she said, free cash flow was $130 million in the second quarter, down versus a year ago from our strategic decision to acquire and hold more hardware inventory in the near term. We expect the conversion of adjusted EBITDA into free cash flow to improve in the back half of 2026. Over time, we expect to see a corresponding benefit to free cash flow with higher conversion rates when we choose to scale down to more normalized inventory levels. So I noted here they're holding more hardware inventory on the balance sheet, and there were some references to memory prices on the earnings call. So I think that they may be holding more hardware inventory to hedge against the memory market. We know stocks like Micron and SanDisk have seen their share prices appreciate dramatically, and there's a supply bottleneck for memory right now. And so I'm thinking Toast might be trying to hedge against that. They did also note some other things on the call about things they're doing to try to manage those increased memory costs. And so this obviously is a good thing if you think about it from a capital allocation standpoint. They're looking at what do we need to do to make sure that we can continue to grow the business, that if we have customers who want to buy our products, that they're available, and that we're not going to be in a position where we're paying more for memory later because we didn't have the inventory available. So I personally don't think that this is poor capital allocation at all. Lowered free cash flow some in the near term, but it allows them to continue to try to grow the business as they add customers. So, in the outlook part of this, they expect non GAAP subscription services and financial technology solutions gross profit to be in the range of $615 million to $625 million, which would be 22 to 24% growth compared to quarter three of 2025. And I noted that this is slower growth year over year than what they've had in quarter two, but they're also starting from a place of having higher gross profit in quarter three to begin with. And I think that's probably because quarter three includes summer travel, tourism, and things like that. But this growth that they're saying they're going to have is still solid. So, not something that I'm alarmed by. Non GAAP subscription services and financial technology solutions gross profit in the range of 2,325 million to 2,355 million, so about 2.3 to 2.4 billion dollars, which would represent 23 to 25% growth compared to 2025, up from 21 to 23% growth. And I noted here this would actually be acceleration in growth, and that is in their two profitable business segments in terms of gross profit. Because as we saw, they're often selling their hardware at a loss to try to get customers onto their subscription services and have them process their payments through Toast. So this is the profitable part of the business, and they're expecting growth in the acceleration in the growth rate for the fiscal year. So that is a great positive sign. So there were some recent business highlights here. They added BWH Hotels, which is the parent company of Best Western and some other hotel chains. They expanded their relationship with TGI Fridays and rolled out the Toast platform in the UK. And I noted here that I highlighted TGI Fridays was impressed by how quickly their teams adapted to the Toast system. That's, obviously a positive thing. They're going to put positive things in their earnings releases, but it's good to see. They also said Toast recently launched Toast Lab, a new initiative to collaborate with a greater Boston restaurant operator to open a new restaurant location and co-develop, test, and refine Toast technology. As a part of this hands-on partnership, the selected operator will receive strategic capital, executive mentorship, and early access to Toast products. And I said, I like this because this is an example of Toast developing products with the customer in mind. If Toast is listening to feedback, working with restaurants directly to try to make their products as helpful for those businesses as possible, that's going to help them to get more customers and ultimately retain those customers. So a very good quarter from Toast with solid growth and a focus on profitable growth. I like the capital allocation in that they decided to add to their hardware inventory at a time when they thought it was advantageous. If it is a hedge against the memory market, then I really don't hate that move at all. If you're Toast, you want to make sure you have enough inventory to get hardware systems into the hands of customers that want them, because that's going to help you grow your business. On the earnings call, they also discussed other things that they've done to help to manage the increases in prices in the memory market. And taking it back to capital allocation, I also like that they chose to buy back stock in the quarter because I do think their stock has been priced in such a way that it has reflected growth at a reasonable price. But a common theme of the video has been that if you're sacrificing free cash flow to spend money growing your business, the market has to trust your capital allocation strategy. And I do think that management did a good job in the earnings call of convincing the market that their capital allocation strategy was sound. And I think that might be why the stock was initially down after hours, but then actually gapped up and finished the next day up almost 3%. An analyst from Evercore actually said on the earnings call, your message is crystal clear in the sense that you're investing for growth and for good reason. Now, even if that is the message, the market has to believe it. And based on the market's reaction the following day, I think that it did. So let's take a look at a valuation for Toast stock. And I have three different scenarios here. I have a base case, a bull case, and a bear case for each one. I kept the revenue growth assumptions the same. So for fiscal year 2026, I'm assuming 21.24% revenue growth. For fiscal year 2027, 18.36%, and then 16%, 14%, and 12% the following 3 years. And then for the base case, I'm assuming that in fiscal year 2030, they will have a 12.5% net income margin. I'm also assuming that they continue to reduce their share count. I don't think it will be as aggressive in terms of buybacks in future years necessarily. They actually don't have a lot of authorization currently left available, and they only have about $100 million left. They bought back a lot of stock so far this fiscal year. So I am not going to, assume that they're going to buy back too many shares in the years after this one, but I am going to assume that they offset dilution and reduce the share count somewhat. And I'm using diluted weighted average shares outstanding assumptions here. So that helps us to get a diluted earnings per share number. They don't pay a dividend. And then you look at the potential stock price at different PE multiples after fiscal year 2030. And then you can see the upside and a CAGR based on 4.5 years for different multiples. So let's say the stock trades at a 20 PE in fiscal year 2030. You're looking at about 63% upside between now and then. And over the next 4.5 years, you're looking at about a CAGR of 11.5%. If it trades at a 25 multiple, now you're looking at a CAGR over the next 4.5 years of about 17%. So not a bad return. If we look at a bull case, let's say the net income margin is 15%, your returns could be higher. So if they then trade at a 20 multiple of this in fiscal year 2030 or after fiscal year 2030, I should say, then you're looking at a CAGR over the next 4.5 years of about 16%, and you're almost doubling your money in about 4.5 years. So, that would be a really good return. For the bear case, I said, what if they only get that net income margin to 10%? And so in that case, your returns probably aren't as good. If the net income margin is lower or if growth slows, you're probably also going to see a lower multiple on the stock, maybe 20 times or below at that point. But in a bear case scenario like this, if it could trade at a 20 multiple over the next 4.5 years, you're still looking at about a 6% return. So still a pretty decent return anyway, not what you would prefer in an individual stock investment, but still not bad. Another thing I'd like to look at here is the stock chart. So we have what looks like a bottoming pattern to me, and then some signs of momentum. You had a crossover of the 9 and 21 week EMAs at the end of July. We're above the 21 week EMA and the 20 week SMA. And in terms of our weekly moving averages, the stock is trying to get above the 100 week moving average, but it's above the 50 week moving average and the 200 week moving average. So if we can get above all moving averages, I think things would be looking a lot stronger. In terms of pivots, we are almost to the weekly pivot. So that will be a important level there. And I just think that this is going to clear these levels, and the stock is going to do well. I really like the momentum I'm seeing here, and I think that this one could do very well. So, in short, Toast, Amazon, and Meta were all capital allocation stories to some extent during their earnings reports, and how much the market trusts a business's capital allocation when that business is taking away from its free cash flows to invest in itself is very important for the performance of a stock. I think the management at Toast has both me and the market convinced that their capital allocation strategy is sound. And I think there's still opportunity for this stock over the next several years. But if you disagree or you agree, whatever, let me know in the comments. Let me know what you think. Hey, thanks so much for watching. If you found this video helpful or informative at all, please like the video, subscribe to the channel, click the bell to get notifications about future videos, and follow me over on X at Stock Sale Flyer, where I post about what I'm doing in the market pretty regularly. I really do appreciate all your support, and I appreciate you watching all the way to the end of the video. Hope to see you in another video. Take care. Bye.